this week we have a guest all the way from San Francisco. It's Ben Soppitt from Unifimoney. So Ben, can you introduce yourself and tell us a bit about Unifimoney, please?
Absolutely. Good to speak to you both. So yeah, Ben Soppitt, CEO, co-founder of Unifimoney, not from America, originally from London, and been in the US the last 5 years, was previously in Asia, but before that working primarily with Visa out of Singapore. But I also launched a digital bank in Indonesia prior to that. So the genesis of Unifimoney was a few observations about the market. One observation was that the challenger bank space was primarily focused on subprime mass market consumers. And if you look at digital adoption in most categories and most markets, it's the young, affluent, urban professionals who've really led adoption. And yet those people were really not in the focus for the majority of challenger banks, and were left with the option of buying the same products and services from the big brand banks. You can buy exactly the same products from Chase, or you can buy them from Wells Fargo or Bank of America, which is really no choice at all. So we saw an opportunity to serve a different group, and rather than compete with the existing challenger banks in the market, we wanted to compete with the biggest, most profitable banks in the market for their most important customers, affluent millennials. And the second observation was that 30 or 40 years ago, it would have been quite uncommon to have more than one, maybe two banking or financial services relationships, which was very simple and straightforward from one perspective, regardless of the value and the quality of the products that you might buy. At least you were buying them from one place, and that was pretty simple and straightforward. Now it's not uncommon for an affluent millennial to have 10 to 15 separate apps to manage their money. And fintech has done an amazing job of optimizing for discrete individual elements of the overall value system, or the ecosystem of financial services. But it's actually created an enormous amount of cognitive load and work in managing 10 to 15 separate apps. So we saw an opportunity to really lead the rebundling of financial services, and build where we think the market's going, which is a small number of apps that really aggregate and bundle the best fintech services in the market, and make it simple for consumers to access the best products and services through a single interface. And you can see the markets very slowly going from there. You can see the first wave of fintech companies beginning to add on bits and pieces to their core product. But no one's really building that future end state today. And so that's what we set out to do and are building.
I love it. I mean, I think the focus on this kind of, I guess, a niche, but it's going to be a large customer audience, right? Is typically what I've talked about in terms of experience-driven banks. They find a niche and try to serve it end to end. But I mean, when it comes to these high earners, I mean, is this a mass affluent play, or is it a wealth management play, or somewhere in between? Where does it fit?
So I think it's a new category, and those terms I think are very well suited to the old world. Unfortunately, you end up with terms like digital wealth management, which I'm not sure is any more helpful. But there are 15 million, according to research, affluent millennials in the US. So these are people typically earning 100,000 plus, and they're very concentrated into certain industries. So medical professionals, law, finance, tech. They're very concentrated into specific urban centers: LA, New York, Austin, San Francisco, etc. So they are quite a distinct audience, and they do come with a very distinct profile. Yes, they're high earning. In the Bay Area, it's not atypical to find a 26, 27, 28-year-old engineer earning 200,000, 300,000, 400,000 plus bonuses and shares. which is an extreme outlier in the general scheme of things, but actually not that atypical down in the peninsula with Google and Facebook and Salesforce and everybody else. But these high earning individuals also have very high student debt, typically. The average student loan in the US is $30,000. The average for a doctor is $250, even higher for a dentist. And then you're living in the Bay Area or LA or New York or Austin or Seattle, some of the most expensive, highest tax areas in the country. You don't have assets yet. You haven't bought that house and been sitting on it for 20 years. So it's a very specific profile, and most companies are not focused on that specific profile. They're focused on the average. So SoFi, for example, if you look at their student loan product, they offer a $350 fixed bonus for refinancing your student loan. And we realized very quickly that that's essentially penalizing people with higher student debt. So if you're a doctor, that's a very poor value proposition. If you've got an average of 30,000 in loans, it's perfectly reasonable. So what we did is work with a company to create a student loan refi product that actually had a variable bonus. So you actually get rewarded the higher your student loan debt, up to a maximum currently of $250,000. So an average doctor would get a bonus of $2,500 with us, but only $350 with SoFi. So we are focusing very specifically on this particular group and seeking to serve them in a way that we don't see either fintechs or the big brand banks actually serving their specific needs.
I mean, I think it's really interesting because we have talked about some of this, Ben, and I think one of the things which I was really struck by was that sort of notion of kind of people sweating their assets or wealth creation. It's sort of, how do you kind of aggregate what you have together to kind of give you more? And I sort of think that's I guess observationally one of the things that I can kind of see within Unifimoney as well is really helping people to kind of optimize what they have.
Yeah, the industry is really structured in a way that's very, very different to the way we as consumers think about our money. We think about it in a very holistic way, regardless of whether it's in investing or in your mortgage or on your credit card. But the industry sees these as separate product lines, separate P&Ls. Even if you're getting your credit card, your mortgage, and your checking account, God forbid, from Chase, these are all completely separate businesses within the company, and you are treated as such. So there's absolutely no intent to try and solve for the friction in moving around money or looking at your money holistically. And if you think how the industry has solved for friction in payments, they've done a really amazing job. You get out of your Uber, you don't even have a payment moment. You go into Amazon Go, there's, again, the payment moment has disappeared, and you have to think, why is that? Why is the industry working so hard to solve for friction in payments? It's because there's an economic incentive for them to do so, because they know that the easier something is, the more we will spend. The same is not true in saving and investing. It is not in Chase's economic interest to have those cash deposits for which they're paying you the princely sum of 0.01%, and which they're lending out at 10, 20, 25% APR. It's not in their interest for you to put that money in Vanguard and benefit from compound growth, because they're not getting paid from that. So of course, if there's no incentive, no economic incentive for them to try harder, for them to deliver better value for money, for them to remove the friction, they're not going to do it. They're earning quite enough money as it is, thank you. So what we're trying to do is really solve for the friction in saving and investing, because we think it's in the best interest of consumers' long-term wealth creation. And we want to rise and profit and be a sustainable business in concert and in parallel with our consumers, and really replace the somewhat difficult relationship, some might say exploitative relationship between the big brand banks and their consumers.
Yeah, I mean, I think that's one of the things I've sort of read some of your articles that you really the exploitation of us by the banks, and how kind of easy it is for them to do that, I think is
and they've trained us really well as consumers. I call it Stockholm syndrome for money. We defend the big brand banks because we don't want to deal with the mental anguish that maybe we've been doing it wrong for the last 5, 10, 15, 20 years. And that's a I've written a lot about this, but I believe the real challenge in fintech and financial services is not in engineering, it's in psychology.
Yeah.
And we need to understand and help people overcome their own psychology. And it's not easy. It's no easier to get people to give up bad habits like smoking and drinking and not exercising. It's just as hard to get them to give up bad habits like leaving money sitting in a depository account paying 0.001% interest, not redeeming all your credit card rewards, and not dollar cost averaging. And
I remember doing some work for like the Halifax in the UK, and there was a point in time when just under 1 million people, generally the older part of the population, wouldn't give up their passbook, because they felt that that's what their bank was. It symbolized the bank, right? So there's huge inertia to kind of give up the past, and nowadays, but my kids think about money in a totally different way. That their attitude is, I don't need a credit card. Why would I use a credit card? Because I'm in danger of paying some high fees, right? Why don't I just use my debit card? Then at least I know I've got the money to spend, right? Totally different attitude. The first thing I did was get a credit card, right? Second thing is, I said to my son, how much have you saved, while you've been, working, etc. He goes, Dad, why would I save? He said, I can get for for £20, I might get like 5p, if that, right? But if I put £20 on Betfair in the Man United game this weekend, I might get like a fiver or a tenner, and the odds might be not fantastic, right? But I'm still going to earn more money. Right? But you get to that point, and you kind of think, well, hold on one sec,
Well, so this is there's so many things happening there, but the fact that consumers think gambling is the right answer to manage their personal finances is hopefully not something that most people will end up concluding. But however, you make a good point, which is having your money in savings is a slow suicide for your money, and yet the stock market in the US, the S&P 500, has delivered over 10% annualized returns. It's a lot of variability, but it's the long-term trajectory it has been extremely consistent, and it's by far the best place to put your money for the long term. And you dollar cost average to manage the timing risk, but you still see companies out there that are essentially high interest savings account and trying to build their deposits and their customer base by subsidizing using investors' funds, what is believed to be a high interest rate, but it's still below the rate of inflation. So the answer is not to keep your money in a X% high interest savings account. The answer is to keep as little as money as possible in cash and drip feed into a low cost diversified fund for as long as possible. And if you do that, you are guaranteed, as near as can be guaranteed, that you will retire wealthy. The same is not true of gambling on Manchester United or
yeah, I mean, the point was really that this gen thinks differently about money because they're in a very different situation. We're in a low interest rate environment.
Well, they're also got the benefit of 20 to 30 years of compound growth ahead of them, whereas the three of us do not. So yeah, I've had this conversation with typical angel investors who are generally affluent boomers and men as well. You can't teach an affluent boomer male anything about money because they're the experts, and they actually get quite annoyed when you say, Chase Sapphire Reserve, that's very expensive commoditized product that you've got there. You can do better. And I had one guy I remember at a meeting say, you're not solving for anyone's problem. I have, the follow, and he listed 15 or 20 different accounts with different platforms, but he'd been doing this for 20, 30 years. So he'd completely habituated to this level of complexity. And I think one of the things, and there was no point trying to change his mind because he was 20 years away from death. And that's not enough time for compound growth to make a difference. And maybe he's so affluent, it doesn't matter anymore. But if you're 25 and the average age of saving for investing for retirement is 32, that's 7 years of compound growth, that you can benefit from. And it's the most important years. It's the early years. And so, if I were to try and summarize what we're trying to achieve in the bigger macro market, is to try and get the average age of saving for your retirement down from 32 to 25. That will create trillions of dollars of value going straight to consumers' pockets by the time they retire. It's incredibly powerful, but it's not what the majority of the market is pushing towards.
I guess what you have is a confluence of things that are going on. So technology gives you access to these things in a lot easier way than there was previously possible. But I think, I guess one of the other things is access to things like tools to be able to plan this stuff. So, one of the problems with pensions or long-term savings has always been, what does that look like? Like, you have this sort of 20 years in the hence, do I sort of spend money on going down the pub or put money in a savings account? Because I can't quite picture what happens in the future. But I think technology is increasingly making it possible to kind of see what that looks like. So
absolutely. And you can take that, if you had to make that decision every Friday night, do I take $50, 50 pounds to X and enjoy myself, or do I do Y? More often than not, with the best intentions, we're going to end up going down the pub and spending it on fun, because that's, you're in your 20s, that's what you do. So the way technology can help solve for that is by making it automatic. So you can do both. You can enjoy yourself without the mental tax of worrying about, do I save $2.50 on a cup of coffee? And really that's what we're taking. And I think that's what we're doing. So I think Acorns was the first to really popularize that idea of, once you've set it up, it automatically saves and invests on your behalf. And you remove the mental tax of having to make those decisions. Do I do the good thing or the bad thing? You can do both, or the fun thing and the less fun thing. And saving and investing should be, for the majority of the time, very boring. And it's why we don't do it. There's no payoff. The payoff's in 30 or 40 years' time, whereas going down the pub, that's an immediate payoff. There's no competition there. You're going to lose. So what we've really done is taken the idea of Acorns and passive investing and really extrapolated that and made it much broader and much more pervasive across all of your financial life, not just a limited slice of it.
So, when you talk about all of your financial life, I guess, are you, what's the sort of span of products that you've kind of got?
We segment personal finance into 3 categories, and we play in the first 2. The first one's everyday money management, saving, spending, and investing. And our principal hypothesis is you should be saving and investing as often as you're spending. So we offer a high yield checking account. So it's a true checking account, but paying savings level of interest. One of the early discoveries we made was that there really is no reason to have a savings and checking account. And the majority, if you look at the statistics, on average, people earning more than $160,000 have $42,000 sitting in a checking account, most likely with a big brand bank, and earning little or no interest. And that money over 10 years, 20 years, 30 years in a savings account can actually have meaningful impact. So we created this hybrid checking savings account to reduce the complexity of worrying about moving money between different accounts, because the fact is most people just don't, because it's hard work, it's manual labor. So we simplified that. Investing, we have both robo investing and self-directed trading. Uniquely, we're offering cryptocurrencies. We have 26 different cryptocurrencies, as well as we're the first fintech in the US to have precious metal trading natively in our app. And we're also planning on announcing a credit card in the near future. and you passively invest every single month, every time you use the credit card, every time you get deposit interest. We also mandate, and this is fairly unique, we mandate our customers have to have a minimum contribution into their robo investment fund. And the minimum is very low, it's $25, and it can be as high as you want. And that's an interesting dynamic, because a lot of people, when they first sign up, they go like, "Oh, you're telling me what to do." That's not sure I'm comfortable with that. But after a few months, and they see, they see it's working, and they see that we're forcing them to do what they should be doing, and that it is good for them. Then it becomes a really important part of the value proposition. The second category of value-added services, and these are things that are typically higher ticket, but much less frequent. Buying a house, buying a car, refinancing your student loan, international remittances, health savings accounts, insurance. And we offer those through third parties, and we have most of those already today. And then the third category is more customized legal and tax advice, and we're not involved in that. Who knows in the future? But what we're really trying to solve for is the vast majority of mass affluent consumers' problems with money. We're seeking to solve for those. And if you look at the sins committed by mass affluent consumers, they're generally sins of omission, not commission. It's what they don't do that hurts them. They leave money sitting in a depository account paying little or no interest. They don't maximize the rewards from their credit card program. They don't dollar cost average into a low cost, highly diversified fund. So we use technology to automate all of those things and remove the vast majority of mass affluent consumers' sins with money, to help them grow and protect their wealth over time. So this is very much the personification of the get rich slowly philosophy. We're trying to take the pain and the effort and the cognitive load out of that, so that in 10, 20, 30, 40 years time, they're going to retire significantly more wealthy than they would have otherwise.
I mean, I like when my kids were born, I just put a few bit of money into pension accounts for them. I don't know why I did it, but I set up a pension accounts for each of my children as they were born. And we got a statement the other day, and I was like, bloody hell, that's like the power of compound growth. I mean,
yeah,
so I think.
But what no one tells you about compound growth, no one, there's thousands.
No, I know, but it was sort of like that moment of magic where I was like, look, kids, this has gone from this to that. And you could see them go, wow, that is like magic,
The really insidious thing, though, is it works. There's a negative to compound growth, which is compound negative growth, compound cost. And the problem with that is it's painless. It's like the boiling frog problem.
Yeah.
By the time you've realized you've missed the opportunity, that opportunity is never coming back, because you can't take 25 years of your life back.
No, it's very.
It's a cruel reality, is that most of us are suffering from the opposite of compound growth. And I think it was Einstein who said something like, those who understand it profit from it, those who don't pay it. And the vast majority of us are paying the negative of compound growth, because we're not doing the simple, disciplined things of, investing a small amount from as early as age as possible, because it's hard work, it's complex, looks difficult. Maybe I'll make a mistake. Maybe I think I'm going to make all my money on Bitcoin, and it's a psychological problem.
But I thought that sort of philosophy of get rich slowly, I think is a really nice one. I mean, I think that's,
and we all buy into it intellectually. The problem is almost none of us buy into it. From
I think part
of view.
I mean, we've worked in banking for so long, and what you see is people they're sort of like, you've got fear, uncertainty, and doubt. You've got laziness. You've just got lack of understanding. And I think
Jeff Bezos had a conversation with Warren Buffett, and he said, "Warren, why does no one follow your secret?" And Warren said, "It's because nobody wants to get rich slowly. They all want to get rich fast."
Yeah.
I think, I think I guess what's nice about putting all of this in one place, though, and sort of aggregating what you see from a kind of wealth perspective, is that it sort of introduces a lot of these things sort of in a nice, easy way, so that, I guess one of the things, like, Dharm and I have talked about crypto trading, and as far as I can see, that is no better or no worse than putting money on a horse or putting money on.
That's where my son gets it.
Well, no.
So the way I think about crypto is, in 20 years' time, is crypto going to be a massive part of the economy and our daily lives? Yes. The same is not true of the horse.
No, I know.
That horse will be dead. It'll be dog food.
I'm sorry, but my point was more about, it's just like, trying to get your head around it is quite a complex thing.
So that's one of the reasons, we very much, at Unify Money, we very much subscribe to this idea of the sort of 85-15. 85% of your investments should be super boring, very, very dull, very low cost, S&P 500, FTSE 100, 200, whatever it might be. Then 10 to 15% of your investing capability, you should experiment. You should have some of that with Bitcoin. You should probably have some precious metals. You should probably try some alternative assets. You should probably have a go at stock picking. If you work in a particular industry and you feel you have significant insights, or you have a particular brand that you like, it's a very good way of learning and keeping engaged. And but it should always be with the recognition that you should be prepared to lose that money.
Just on a separate note, I was looking at Unify Money, well before this, and one of the things that I absolutely love is the videos, but content seems to play a much stronger role in your brand and your proposition than it does for other banks. Can you shed some light on that? Like, what's driven you to do? I absolutely love the videos, by the way. I think they're superb.
But the videos, so it was a bit of a joke, but we did a press release that we were the only bank in the world with an in-house comedy sketch team. And we produced about 10 videos now, which really are quite satirical. And they poke fun at the big brand banks and the way they present themselves. And also the frankly bizarre relationship we as consumers have with them. And the reason we did that was simple, and it was born of conversations with people where we would say, what's your financial stack? And they will say, well, I'm my checking account is with Wells Fargo. I've got the Chase Sapphire Reserve card, and I use Robinhood, plus, all these other apps that I have on my phone and don't use. And then we would try and have a rational discussion with them about why that maybe wasn't optimal for them. And people would get very defensive, particularly men, and particularly about credit cards. And you couldn't talk to them because, and the more you talk to them and you're using statistics and rational argument, totally irrational. No. It might be true of everybody else, but it's not true of me. I'm getting one over on Chase. And I was actually talking to a guy from JP Morgan Chase the other day, and he was laughing. He was saying, these idiots, they think they're benefiting. They think they've got one over on us. We have hundreds of thousands of customers. We have billions of points of data. We have more resources than they can possibly imagine that are designed to take their money off them. And yet they think that they're getting one over on us. It's hilarious. And, people, affluent, successful, well-educated, intelligent people, particularly men, do not like to be told they made a bad decision, or a decision that maybe is less than optimal around their personal finance, because they consider themselves experts because they're rich, therefore they must be, knowledgeable. So instead, there's a very fine line between education and insult. So we decided to use comedy and satire as a safe, non-confrontational way to maybe place the question mark in their mind and maybe make them open-minded to the possible reality that maybe there is space for something different in their financial stack. And it was a lot of fun as well. And it wasn't that expensive. And it was fun, but it had a serious intent, which was to try and sow the seeds of doubt in people's minds who might otherwise not be open to a message that there could be value in changing their financial stack or adapting it.
So is your focus more on kind of like, are you seeking to educate these people into into managing their money better, or are you looking at automating it, or a bit of both? How would you see the service?
I think the only, unless you're a very, very unusual person, and there are a few of them, and you spend an inordinate amount of time managing your finances, then it's a practical impossibility to manually manage your finances over the long term. We all have the January New Year, let's go to the gym, let's sort out our finances, and it doesn't last very long. And therein lies the big brand banks' disproportionate profits. They rely on our inertia, not only in our willingness to switch provider, but also in our willingness to optimize for ourselves. And it seems ridiculous. Who wouldn't want more money? We all want more money, but no one's willing to put in the work. Just like Warren Buffett said, everybody wants to be rich, but nobody wants to do it slowly. So the only way, I believe, to overcome our natural cognitive bias against hard, manual, repetitive, boring work is to automate it.
Yeah, totally agree.
So I think, educate is a strong word, and our customers are some of the smartest people in the country. They're doctors, they're surgeons, they're lawyers, they're finance professionals. It's to if they actually applied themselves, they could easily do this. I talked to one customer, ex-banker, ex-Capital One guy, and he was talking to me about his financial stack, and he spends several hours every day managing his money with his wife. And I said, well, listen, you're doing an amazing job. I don't think we can help you. I don't think we can beat what you're doing manually. And he said, but you know what? I've got young kids. I would rather spend time with them than on a spreadsheet, and I will give up some of my returns to spend more time with my kids. And that's a really weird outlier, but fair enough.
No, it's interesting. Well, look, we're running out of time, so we had to one sort of final topic, which I think is worth discussing. It's just is sort of compliance, risk, insurance as well. So, like in the UK, if you set up, you've got a bank account, that's kind of covered for if something should happen to the bank or whatever. So how are you sort of set up? So
we have the FDIC insurance up to $750,000 through our bank partner, UMB, which is a FDIC member bank. So consumers, and we also have SIPC insurance for investing through our broker dealer Drive Wealth. So consumers' funds are always protected, but there's a bigger risk, and it's quite it's very specific to the US. It's not something you suffer from in the UK or most markets, which is the regulation here, frankly, encourages fraud. And it was all done with the best intent and to protect consumers' rights from vicious, evil banks, which I understand. But it's had the unintended effect of actually encouraging and protecting fraudsters. Right. So the need to invest significantly in not just one or two platforms. I think we're working with 9 separate platforms currently, because they all do a great job in a very niche area, whether it's synthetic fraud, whether it's real-time transaction tracking and monitoring and blocking, and it's a real overhead. And we simply wouldn't have this in the UK. But unfortunately in the US, the infrastructure is such and the regulation is such that we have to spend almost as much energy on security and fraud software for very simple things like linking a bank account or doing a bank-to-bank transfer. In the UK, it's faster payments, it's immediate, super secure, super cheap. In the US, super insecure, super bad experience, very, very slow, and a very high risk of fraud. So yeah, we're spending just as much time in armoring the platform against that as we are building product, which is an unfortunate cost of doing business in the US.
Okay, well, thank you so much. Well, listen, it's been brilliant. Really insightful. Thank you so much for your time, and good luck with it all.
Thank you.
Fantastic.
Cheers.